We've had a short break after hearing about international equities, and now we're going to turn to infrastructure, led by Nick Langley from none other than ClearBridge, and another stellar lineup in Nick Schoenmaker, Rob De Silva and Rafio Khan. Now Nick, as I said, is from ClearBridge, where he co-manages all global infrastructure strategies. Nick co-founded, actually there's been a lot of co-founding being done today, so love the teamwork guys. Nick co-founded Rare Infrastructure in 2006, and before that, he was at AMP Capital in infrastructure funds management team before it was a cool asset. Our next Nick is client portfolio manager at Drummond Capital Partners, and they're award-winning fund managers, as you heard earlier. He has 17 years experience in investment markets, spanning portfolio management, investment strategy, manager research and more. He has a background in private banking and, yep, you heard it, he's a CFA charter holder. There's more CFA charter holders in here than there are uneaten cinnamon scrolls. I'm helping with those though. Rob is known to many of us in this industry and of course heads up to Silva Consulting, as well as being a member of the IMAP Awards judging panel for the last 3 years. I believe he's a very hard marker. He was previously head of research at SQM, also at Van Eyck Research, and yep, he's another BT alumni. Rafio joins us from Innova and brings a decade of experience in our industry, specialising in in-depth research of funds managers across varied asset classes. He prides himself in strong quant skills, supported by his Bachelor of Economics from Macquarie University. So please welcome the team.
Up on the slide there, on the left-hand side, think about infrastructure as two categories, right? You've really got on the first regulated and contracted utilities, think poles, wires and pipes. These companies have a pass-through of inflation. They have a pass-through of bond yields in the medium term, so you get a bit of short-term volatility with bond yields, but in the medium term it passes through, and they don't take GDP exposure, right? The regulators do not care how many electrons or molecules pass through the networks. What they care about is that the infrastructure is there to connect the houses to the grid so that the lights don't go out, right? So those companies, therefore, are the more defensive end of infrastructure. They earn a return on their underlying assets. So you want to know that they have the capital to continue to invest in their asset base, that their asset base will grow over time, and that regulators will provide them with a steady return. Right? If that's happening, then they should have growing earnings, growing cash flows, and growing dividends. Now, on the right-hand side, user pays infrastructure. So think about anything involved in moving people or goods around the economy. Roads, rail, ports, airports and the like. We mix in a bit of communications infrastructure in there as well. Now they also have a pass-through of inflation generally. They are exposed to bond yields though, right? Think of them as long duration assets because they don't have an ability to reprice their services as bond yields change. Similarly, they're very exposed to GDP as well. Right, and obviously during the pandemic, when we closed down our economies, it was the airports, it was the roads and the rail and so on that hurt the most. When you put these companies together into a portfolio though, something interesting happens, right? As an active manager, we get the ability to tilt our portfolio either towards defense as we're heading into recession or cyclicality as we're coming through the recession and looking forward to some growth. And that's quite important. So on the left-hand side there, it allows us over a longer time period to protect capital in down markets. And so we've got a beta in a down market of a little over 0.6, but get a reasonable share of the upside as markets are rising. So at a beta in up markets of 0.8. And that skew becomes really important when you think about compounding returns over the long term, as you can see on the right-hand side. You end up with a much better outcome than other opportunities. Let me touch briefly on themes. Some of these we'll explore in more detail as we get into the panel. Decarbonisation or energy transition being an obvious one. Interestingly, a decade ago, a high growth utility was growing its asset base at between 4 and 5% a year. Today, those high growth utilities are growing at between 8 and 10%. Right, and it's largely a result of energy transition. Building out the networks for electric vehicle charging infrastructure to add more wind and solar, together with the building of those wind and solar facilities. We've seen a fracturing of the global economy. We're hoping we'll get a chance to talk a little about geopolitics and what's going on there, but obviously that's one of the things that's driving the nearshoring, onshoring and friend-shoring that we're seeing going on at the moment. And as you change the flow of goods, then you need to build more infrastructure or augment your existing infrastructure to support that change in trade flows. In addition to the onshoring, bring that manufacturing capability home, you then need a lot more energy to support those manufacturing plant in the economies. 5G evolution's an interesting one. We're quite careful about where we take exposure here. Predominantly for us, this is wireless tower companies. They sign 15 to 20-year contracts with their carriers. Those contracts are inflation linked. We do not include data centers, for example, in that category because their contract lengths are too short. And ultimately, we aim to be a very boring sector that generates steady income and steady returns for investors over time. We don't want to be at the leading edge or the bleeding edge of technologies. Just briefly in terms of where we see things going from here, when we look at the portfolios both on the income and the more balanced value strategies, you're looking at pretty solid forward-looking returns. They're actually a little higher than that as of today. When you look at that forward-looking return, you're about 4 to 5% per annum in income coming through. So there's a good flow of dividends from the underlying companies that gets paid out in terms of distributions on the fund. There's solid growth from our existing asset base in kind of the 5 to 6% range. And that's the continued augmentation of existing networks and the returns that are generated from that from our regulators. And then there's another 3% of future growth as yet unidentified, but we know it's going to happen as we continue down this energy transition path, for example. And as part of that, we'll see some normalisation of valuations and so on as well. So we're looking at in the order of 13% annualised returns over the next 5 years. That's total return, local currency basis across our portfolios. So pretty healthy return out of this space. What I'd like to do now, though, is drop into the panel and we'll talk a little more about what we're seeing in the space. All right. So given our time constraints, we might skip over some of the macro and kind of geopolitical side of it. We'll come back to that at the end if we've got a chance. But to talk a touch about what's going on in the sector and energy transition in particular, broadly, we need to spend $100 trillion over the next 20 years across the globe. Rob, how do you think about what that's going to do for infrastructure?
Well, I think there's two sides to the equation. Obviously, no matter what you think about climate change, there is an unrelenting force and momentum for investment in this, and an urgent force and momentum for investment in this area. As you said, $100 trillion. And so the demand side of the equation is pretty identifiable. What technologies might come to the fore can be debated, but there's not much doubt that the demand is there to be satisfied. So it's to my mind, that's well known. People know about transition. It's in the news every day. What's possibly not as well thought about is the risks around all of this, because there's more execution risk in these sort of areas than traditional infrastructure. Humans have been building bridges and roads and dams for hundreds of years. They've been building data centers in volume for maybe 20, and satellites for God knows how long, and solar and wind technology is decades old. So when you're planning big projects, then you're going to have trouble truly identifying the specific demand curve, but also the costs around building to these needs. And so I think that the execution side of that equation is going to be more problematic than in sort of traditional infrastructure projects. And then not all of them are going to succeed. There'll be technologies that won't work and execution that doesn't work. And that's sort of compounded by the fact that you don't have a lot of historical evidence to work from when you're planning and trying to figure out how to get this project up and running. So you might be underestimating the costs or overestimating the demand. And the final thing is that disruption is great and common, and people understand that it goes on. But what you forget is that the disruptors can get disrupted as well. And so whatever the latest, greatest green technology is that everyone's pushing for may not be what kind of works in the future, which might mean that there's some green assets that end up stranded as well over time. So it's a very fluid and dynamic situation. So look, in summary, I think it's like great opportunity, but also high risk. So it's a high risk, high return kind of strategy. And I don't think it's sort of thought about in that framework a lot nowadays.
Yeah. And Nick, I know you kind of come at it from a risk spectrum, a slightly different perspective as well. What's your sense of the impact of the climate change kind of mitigation policies?
Yeah, so I would probably agree with most of what Rob said, so thank you for that. I guess there's different cross currents involved. So obviously a lot of infrastructure assets rely on carbon intensive energy sources, so there'll be quite a lot of disruption. If you think about electric vehicles, for example, there is, a push in, I think, the UK, not Europe, but the UK, Japan, China, to get rid of internal combustion engine vehicles by 2030 or 2040. So as electric vehicles get rolled out and the battery technology becomes stronger, you can actually see, I believe, houses that can have most of their electricity sourced from the car batteries alongside rooftop solar. So that could be very disruptive for electricity grids, but it could also then be positive for rooftop solar. Another kind of example, in terms of disruption, would be looking at certain states in the US, like California, for example. I think all the way back from 2019 had banned new gas connections, new dwellings. So obviously that can have some negative impact for gas pipelines, but there'll also be some structural positives out of that for kind of renewable energy through time. So politics is one to watch. I mean, we are in a world where we have more polarised and populist politics. What could that mean? You could have declines in the regulated return from infrastructure potentially, depending on how populist different parties would view that. The other thing would be just the risk of assets becoming nationalised to a greater extent. I think the UK Labor Party, I think in 2019 as well, was putting forward mail, water, energy and rail to be nationalised. So there is a risk around some of that. In terms of, the Inflation Reduction Act, as you mentioned, which I think was from August last year, that's a massive tailwind, I think, for infrastructure in the renewable space. Solar would be one I think you kind of alluded to before. So there's a massive pool of money there. I guess one of the risks is that it just doesn't really do too much. I think one area that's probably not spoken about enough is just why we aren't using a lot of nuclear sources for now. But a lot of cross currents, and I think just to echo Rob's comments, just a lot of things to kind of wait and see how it all plays out.
Yeah. Well, listen, we've certainly got some challenges ahead of us. In January this year in Victoria, the difference between the energy demand, and this is net demand after you take off rooftop solar, the net demand at the high point of the day was 3.5 times the net demand at the low point of the day. And to put that in perspective, last month in the US, middle of their summer, the difference was 1.5 times. And so because we're so far south, because we have so much solar, it gives us a unique issue in terms of energy demand. And And ultimately, houses still want to have electricity when the sun goes down and they've still got their air conditioners going flat out and they want to cook dinner and have showers and all the rest of it. So they'll remain connected to the grid, which means we need to find the electricity, which is pretty tough in a place like Australia where we've got a lot of coal in our generation mix, and that's because you can't increase or decrease the power coming out of the coal plant very easily. It's a bit different in the US where most of their generation is through gas, and gas is very quick to turn up and turn down. That's one of the reasons why we're getting warnings about blackouts for Australia. Maybe switching gears just a little bit still within that, what's going on the sector topic, new infrastructure and new categories coming through. I talked a little about data centres, but Rob, what's your view on kind of opportunities, risks, characteristics, and the like?
Well, again, I think there's a few identifiable mega trends to pick up a term that's been used before today that are obvious in terms of what it means for the growth in certain types of technologies like data centers, like cell phone towers, satellites, renewable energy processes. So those all have fantastic sort of growth profiles. And along with those growth profiles, I'm repeating myself a little bit, in the sense that they are all great opportunities. They're recognised as such. It's easy to see the revenue and profit, or at least the revenue side of the equation being very rosy. It's less easy to determine how exactly to make money out of that over time, because especially when you are working with possibly exponential growth curves. So when you're trying to plan and make money off a sector or an industry that's growing exponentially, then just identifying the amount of demand and what you need to do to satisfy is a very tough task, because you might be talking the difference between 20% and 30% growth rate. If you get that wrong, that's a 50% error, is hugely different in what you've got to do at the end of the day to build projects, etc., than if you're talking about 4% to 6%, which is again a 50% increase. And so I suspect that in assessing these things, you've got to pay close attention to the execution risk, because yes, I could say obviously there's opportunities in data centers and satellites and new technologies in energy, etc. That's pretty clear and obvious, and you can try and pick the winners there, but part of that exercise is actually picking the people who can make money, or the projects that can make money out of that, because there are plenty of losing projects that will be started and financed and fail over time. So that side of the equation, the cost side, the execution, the implementation side is going to be very important. And also keeping an eye on the politics of these things as they develop. When any of these become a huge part of the economy, the politicians also, eventually get their say and can influence the outcomes and the prospects for different types of technology.
Yeah, agreed. And listen, from our perspective, as I mentioned, our view is you've got to have hard assets backing these companies, and you've got to have regulators or long-term concession contracts, which are giving you surety of cash flows over that longer term. Listen, we might change gears a little bit and talk about how and where you get exposure to infrastructure and how it fits into portfolios. And maybe that's a place to start, Rafio, in terms of how you guys think about the allocation, where it sits in a portfolio.
Yeah, thanks, Nick. So we look at infrastructure as a sleeve on its own. So for us, it plays a sort of growth exposure for us. And we can empirically see that there are idiosyncratic risks that it can provide to a portfolio. So there are benefits from diversifying, right? So, but the one thing that infrastructure gets sort of lumped with is inflation protection. And protection is a strong word. So when we think about that, I mean, you get income protection, and then you lose your income, and then your protection kicks in. So with infrastructure, when it gets lumped up with as inflation protection, the appropriate benchmark for us we would look at is something like inflation-linked bonds and the premium that we're getting for it. So when you put all that together, those are some of the things that we would look at before allocating.
Okay. No, we might come back to that when we talk about, when is the right time to increase allocations. Nick, how do you think about allocations in the portfolio?
Yeah, somewhat similar. So we would classify infrastructure as a growth asset. We tend to bundle through it from an SA perspective, listed property and listed infrastructure. We're currently overweight listed infrastructure versus listed property.
Thank you very much.
Yeah, no worries. In terms of the asset class being an asset class in of its own right, again, kind of just echoing some of the own thoughts, the thoughts before, the correlations obviously support the fact for it to be a different asset class, and also just the monopolistic nature where there isn't much competition, earnings are more predictable, again, gives the return profile some differentiation from the broader listed equity market.
Nice. Yeah. And Rob, I know you've got a kind of a pretty nuanced view of it.
I suppose you can think of it in a couple of different vectors. One is regulated versus unregulated assets, and you might, and I'm not saying this is what set in stone, but it's an interesting way to think about it, that regulated are a little more defensive in terms of the volatility around it and the expectations of growth and the visibility of earnings, versus the unregulated where there's more volatility around that. So on the one hand, they're all growth. I agree that they're growth in the sense that they rely on the growth in the economy over time, but their response to that growth is different because of the regulation environment. So you could think about regulated being more defensive rather than unregulated, which is more growthy. And then the other aspect is unlisted versus listed. And the unlisted is a different risk profile, not so much in the business risk or the underlying economic risk, but just in the mark-to-market volatility. So whether you kind of agree with it or not, and I've got my personal views about all this, the unlisted assets don't move anywhere near as much as the listed, and that causes, there's different outcomes, different views about those assets in a portfolio where they're seen to be more reliable, safer, etc., a bit more defensive, even though they might be the same assets as opposed to a listed vehicle. And the listed vehicles are subject to the daily whims of the stock market and the supply and demand pull of investors in any one day, and the fear and greed sentiment that happens on a daily basis. So, again, that points to more volatility risk rather than actual economic portfolio risk. And so you might think of that in the sort of growth space as well. So there's some, there's Venn diagrams that overlap all of that in terms of how you might see it in the portfolio.
I was just going to add, when we look at listed versus unlisted, the main question we ask is why would you pay that much more for assets of similar quality and illiquidity, right? So we've seen this phenomena where unlisted assets are trading at a premium to listed, and it creates this situation where a consortium of buyers can take out an asset. And then when you ask them how can they pay so much for it, their argument is, well, they're better at pricing than retail or mums and dads, right? And when this transaction doesn't bring to market any synergies or operational value, right? So my retort to that would be, our colleagues like Mr. Langley and his peers are also good at pricing these assets. So, we would argue the listed market should command a premium because of the utility of liquidity that it provides, and the unlisted should be at a discount. So, common sense doesn't prevail because of the flows of money. So there is a phenomena where the larger players, they want long-dated secure cash flows in the form of unlisted assets, because then they can mark their own homework on valuations and, wipe down the volatility like Rob mentioned. And now we're here. So.
Yeah, and, that's absolutely right. And what it means is there's a new opportunity there. There's a different valuation metric that you can look at, which is what does it cost to build this thing, and how is it being priced in the unlisted versus the listed? And that's an opportunity to go, well, if it's cheaper in the listed market, let's go with that and let the unlisted, stay at that premium. or you can move between the two as the cycle progresses, because you know the listed market is going to cycle like crazy while the unlisted stays reasonably steady. Well, that's opportunity to trade. You don't have to believe that everything's perfectly priced. If you disagree with the way that things are being priced, then you can back your judgment and take advantage of that.
There's a lot more gearing in the unlisted assets too, isn't it? So I think the outperformance of unlisted versus listed is probably more due to the gearing involved in a low interest rate environment than illiquidity premium, perhaps, as well.
That's true.
Yeah, and if you look at how all of the unlisted funds have done versus all of the listed market, actually on a 20-year basis, the returns are exactly the same. So yeah, it is quite interesting. And listen, our institutional clients tell us that the unlisted portion of their book is all about mark to model, and therefore low volatility versus liquidity in the listed side. We haven't talked about active versus passive. Nick, have you got some thoughts there?
Yeah, so we'd definitely prefer active at the moment for a whole host of reasons. One, just more dispersion. I guess that's a broader market theme, that we're going to have more dispersion than when we were in a QE-driven zero interest rate policy regime. Just the fact that there's probably going to be, because of that disruption we spoke about earlier with climate, perhaps a number of stranded assets. So if you've got a bunch of impaired assets coming through, we think good managers that can navigate that will certainly add alpha. So active versus passive at this point in the cycle.
Okay. We'll take some questions in a minute. So if you've got a question, put your hand up. But while we're waiting for that, and Nick, while you've got the talking stick, so to speak, why don't we talk a little about the signs that would cause you to think about adding infrastructure to portfolios and valuations and the like?
Yeah, sure. So just from what I was saying before in terms of being overweight versus global property, just some of the concerns about commercial real estate, for example, is one headwind facing that sector. We think infrastructure will be more defensive. They did behave probably more like an inflation-linked bond last year than what inflation-linked bonds did, given break-even rates didn't become unhinged. In terms of an assessment of looking at the asset class and why now, so yeah, valuations, but also valuations versus the broader listed equity market. I'd be looking at things that are the fundamental return drivers over time. So you could, regress revenue versus things like interest rates, commodities, GDP growth, credit spreads, and have a determination of where you think those factors are going to move over time and how that may affect infrastructure versus broader equities, given we know the greater sensitivity to interest rates and infrastructure. The GDP factor tends to be only marginally, from the modelling we've done, only marginally lower than broader equities, but it depends on different regimes and so on. If it's listed versus unlisted, we would see better opportunities in the unlisted space or private markets in things like distressed debt at the moment that are going to benefit perhaps through special opportunities as companies face funding problems.
Yeah, interesting. Yeah, certainly, we keep a pretty close eye on real bond yields. Obviously, most of infrastructure has a pass-through of inflation. So it's that real bond yields, and if you believe that they're going to roll over and head downwards, then that will certainly support valuations in the space. Any questions around the floor?
Can I start with a question about the energy transition? I mean, you talked a lot about that and how much money is going to have to go into that, the opportunities, but I think Rob mentioned the word politicians. We've seen you can't build windmills because it'll kill the parrots. We don't want transmission lines across my farm, etc. Does that sort of alter the growth outlook? Does that worry you that the opportunities might be slower than you hope, or?
Well, history would show that it has been. There's a whole lot of projects that are backed up. Interestingly, the politicians have listened to that, and that was part of New South Wales looking at its renewable energy zones, and we've seen in the US before the IRA was the Infrastructure Investment and Jobs Act, and one of the things that came out of that was the Grid Development Authority, which is a new authority within the US government, which will take carriage of reviewing and approving electricity transmission lines in particular. And they've also got a program where the Department of Energy can actually be a seed investor and seed customer of new transmission lines to help drive investment there. And interestingly, in the US, because those projects are federally regulated, the companies there are earning between 10.5% and 12% return on the equity that they put into those projects, versus your standard poles and wires in the streets, where you're getting kind of 9 to about 10 or 11%. So premium return and certain drivers in place to help drive some of that investment. But listen, it's an area that is woefully behind in what we need to invest, and one of the reasons that we are going to have blackouts here in Australia, and they're certainly having similar issues in the US and have done for a number of years.
I've got a question about the impact of emergent technology on the infrastructure sector. I mean, we've seen the NBN, $42 billion of yours and my money. Thanks very much. Thanks for coming. I don't know what its current value is, but I'm thinking it's an order of magnitude less than that now, perhaps. Overtaken by things like Starlink and 5G and so on and so forth. So to what extent, in thinking about infrastructure investments that involve new technology as opposed to building another road, does the potential that this technology might not make it or might not have the longevity that's been spoken about so many times in this session? To what extent are you worried about technology redundancy?
The short answer is, in portfolios, not really. And that's because unless I can see 15 plus years worth of cash flows being generated, or a regulated return being generated from that particular piece of investment, then it's not going to make it into the portfolio. So what we are seeing is regulators sign off on pilot projects. A lot of that is around grid stabilisation, different storage technologies and things like that. And so if the regulator says, yes, I will pay you a return if you undertake that piece of investment, then I'm good with that. If not, then it's something that belongs outside of our portfolio. But hey, some of those things are going to be really, really interesting. A lot of the smart meters and so on in the early days, the companies that were promoting those made a huge return, and it will be the case in some of the different technologies that come through. It's just I'm not going to invest in them until they're kind of old and boring and well known. Any other thoughts on the panel?
Yeah, it's really interesting you say that, because I think what that means is that there's such a vast variety of projects, etc., and approaches to this with different risk attached to it. So you're taking, Jesus, what was that? Failure in infrastructure. You're taking a more conservative approach where you're filtering out some of these risks that we're talking about with emergent technologies, etc. But there's investments going on outside your portfolio in other areas, venture capital or big super funds or institutional investors or whatever, who will be taking. Somebody's going to finance these things, right? And they're going to be. Some of them are not going to make the cut, and because people are taking bets on the technology. And so, as an investor, as a sort of retail investor, or a financial advisor, you need to think about that level of risk and whether it's appropriate for what you want to do. It'll be appropriate for some people. Some people want to take a big punt and get a big payoff, and that'll work for smart meters or Starlink or some other thing. But a lot of these things won't work, and so you just got to recognise that risk-return payoff when you're thinking about it.
I would only add, we've come out of a world where it's been zero rates for a long time, so capital has been easy to come across, right? So now the cost of capital is much higher. IRRs need to be higher for these projects, so I think the probability of redundancy in technology is more than zero. So it will happen, but there will be a lot that stays back and probably changes the world 10, 20 years down the track. So I think we just have to be open to that. And yeah, it's more about sussing out what's going to fail and leave that out of portfolios.
Let me just kind of related to that, AI, because everybody's asking how AI impacts everything today. So in a data center, your average rack will generate about 10 kilowatts of heat. I'm not going to, it's just a number. The next generation of AI chips are likely to generate about 100 kilowatts of heat in that same rack. So that's 10 times. Between 2013 and 2018, the amount of compute required to teach a piece of AI software increased by 300,000 times. That was before ChatGPT. Now, what's happened is our chips have got a lot faster, so they can do the computations faster, but they still use the same amount of energy per computation. And so we're seeing a massive uptick in the power required for AI, chips, AI calculations, and training and the like. So that's an area where we're all going to be wrong about the future in terms of energy demand and all the rest of it. What I'm hoping is when you apply AI into the electricity networks, in particular things like forecasting of electricity and all the rest of it, they can help generate huge productivity gains. We'll see what happens. But ultimately, invest in the regulated, hard assets generating long-term cash flows. There's a good place to end.